OpenAI is 500 billion, but it's going to be 1, 2, 3 trillion. It's going to be trillions. I don't know exactly what I can say publicly. Content creation is going to happen next year. What we really aspire to do is to back the next generation of founders. You can get to unicorn status very fast, but it can also disappear pretty fast. Money on paper is not money, and valuation on paper is not a valuation. And that's why we have a lot of zombie unicorns from 2021.
Today on Billions, I'm sitting down with one of Europe's youngest general partners, Jonathan Userovici from Headline, a global venture firm that spots the next billion-dollar companies before anyone else. Jonathan already backed some of Europe's fastest-growing unicorns and is quietly redefining what it means to invest with both data and instinct. In this episode, I want to talk about the behind-the-scene of fundraising, how we spot future billion-dollar founders, and where the biggest opportunities in AI are. And of course, we'll talk cash, secondaries, cap tables, and the real economics behind staying hungry once you reach on paper. If you ever wondered how the next generation of billion-dollar investors think, this episode is your blueprint. Thanks a lot, Jonathan, for being here.
Thanks for inviting me.
I'm super excited to do this episode. We've known each other for a few years now, and I've always admired, like the way you invest in companies and how you back founders. So it's really cool to have you here. I know that you've already invested in a few unicorns, and I would love to understand how exactly do you spot, the best deals before anyone else, because you invest quite early in companies.
We talk a lot about unicorns all the time, and it's it was a great terms to use in the past years to define success, I think, in the venture industry, but it changed also. It changed also. I mean, if you think about what we really try to spot more than unicorns, I would say it's, long-term compounders. So you can get to unicorn status very fast, but it can also, disappear pretty fast. And we saw that in 2021. You have a lot of unicorn stock now at the status that are not, real unicorns anymore. And so, I would say that what we really aspire to do is to back the next generation of founders that are really looking to build long-term big compounders, big businesses that are enduring and sustainable, and at the end of the day that can IPO or stay private for a very long time, but that can be independent. And so, to do that, I mean, our mission is basically to invest early and to help them get to that stage. And so the unique value proposition that we built Headline as a team, and then I can discuss a little bit more in details what I'm doing personally, but the mission is really to help the founders go international and basically conquer the biggest markets that you can go that you can expand into. And so basically our biggest office today is in San Francisco. We also have people in New York, so that's in the US and North America. And then we're in Paris, where I sit today, in London, in Berlin, in Sao Paulo, in Tokyo, in Southeast Asia. And so our mission is to find founders that are Europeans, or, that's my personal missions, and to help them go international. And that's what we're trying to spot, is the founders that can go international, can really think big, and can build companies that, don't hit the unicorn status, but one day can hit, let's say, $1 billion of ARR, actual revenues. So we start with 0, we have them get to 100, and then, obviously the long-term goal is to get to $1 billion.
And do you see any common characteristic for these founders, who want to grow internationally? Is that just people telling you hey, we want to build an international company, or do you see any common traits for the founders?
I think what we're looking after iterating a lot, our job is also to iterate all the time. And to be honest, with the age of AI, I'm asking myself every day the same question: does the founder that, had this characteristic to build very big companies 10 years ago, is it the same type of founders that we should back today? I think, one common trait between, when I started more than 10 years ago, actually, and today is, we're looking for founders that have a very high rate of iteration, testing all the time, and the speed and the quality of execution to try new things and accept when it's a mistake very fast, but also double down when it's the right thing to do, is what we look for. And so iteration, you can see it in many different dimensions. You can see it in the way, and that's probably the thing we look at the most at the earlier stage, is the speed at which you build the product and you ship, the intensity at which you push code new features every other day, every week. And so that's probably, one aspect, but iteration, you can look at it in many different ways, right? So the speed at which you hire people and, great people obviously is important if you want to scale at some point. The speed at which you test new, GTM motions, especially in the age of AI. So I think generally speed is something that is very, important. And that's maybe the first thing. The speed of, learning, what we basically call the learning curve, is probably the common trait is that it's very steep for most of founders who are building very big companies. And this
Do you
is
have like specific examples of a company you've invested where you felt like the speed was insane, like from day one?
in most of the companies we invested. What's interesting is that as VCs, and I think that's a nice tip for founders also who are looking to raise funds, you always try to basically build a relationship with founders ahead of the fundraise. So the minimum 6 months, maybe 9 months, maybe 12 months, before they build the company or before they raise the seed or Series A. And so you can actually assess that for a long time. Sometimes it's not possible. It happens, right? And then you assess that in a very short time frame, and this very short time frame is more or less, the fundraising period. And so most of the founders we back, and the concrete example is really, and all of the founders we back iterates very fast between the first interaction in the fundraising process and the last round. So they would, start pitching something, and they understand the feedback from VCs or from the market is not great, and they would adapt. And then, they would, double down and double click on the things that they felt, were just not great at the first pitch, for example, right? And so, that happens, many times. And what's really interesting is to see that speed of iteration at scale. And so I'm at the board of companies like, Homa Games, for example, or I was for a long time at the board of Swine. And so iterations, speed of iteration is not only at the beginning when you invest and at the seed stage. It's actually more common to have that at the early stage. But what impresses me is to see, founders actually iterate very fast with big companies, 100, 200 employees, sometimes 500, 1,000 employees, and they always manage to challenge the vision, taste new things, adapt, a little bit the pitch, and transform also the initial vision into enough iteration at scale that allows you to find the right path to build an enduring company. And so, typically, a company like Swile, which really started with, meal vouchers, really transformed over time into a company that is, a spend management company dealing with many benefits for employees now going into travel. And you can see that, iteration and speed of basically becoming, product velocity to become a one-stop shop is also insane at scale, right?
Nice.
A company like Homa Games, they started with, so both are actually serial entrepreneurs, Loic from Swile and Daniel from Homa. They really started very fast iteration, hyper casual games, and now the engine that they build and the technology that they build allow them to basically launch super high quality games that are becoming casual games and generating, hit driven kind of revenue scaling, which is very big. And so, you have signs at the beginning, but you also assess over time, and that also defines the way you reinvest over time in a company, which is, a big component of our job.
And you mentioned that the best way for founders to potentially raise is start building relationships like 6 to 9 months in advance. You also mentioned that in some cases, it doesn't really happen like this. I know you've invested in Mistral, so I'm guessing, the round went also pretty quickly. With AI companies and such high valuation, like how do you decide, like to make that call and invest early? Do you only focus on the team? Do you focus like, because you don't really have time, I guess, to see how fast the company can iterate? Like what are your tips, when it comes to it?
There are different examples. Mistral is a little bit also particular because, we are with the CEO, Arthur Mensch, of more or less of the same generation. And so we know a lot of people, in common, and also very good friends of friends. And so basically, I've heard of him and I've known him for a long time. And so basically, when someone of your circle start to build something, you heard of him from people who know him very well, deeply personally, but also professionally. And so the diligence is actually happening, over the years, right? And that's the beauty of being local when you invest at the earlier stage. And now we are talking about, pre-seed, pre-revenue, pre-everything, right? Because we invested in Mistral when they had no revenues. And so when you've been in an ecosystem for a very long time, you track a lot of profiles, and you hear of a lot of people in a good or in a bad way. If you hear about someone in a good way once, and a second time, and a third time, it means you have to double click, right? Just because, when you talk about this friend who is just amazing, professionally speaking, and always, getting promotion early and performing so well at one of the big companies or one of the best startups. I mean, you double click and you start spending time with these people, right? So the diligence is actually happening over the years for many companies. For other companies and for people typically that are maybe not in my circle or not of the same generation, it can be older people, it can be younger people, it can be other circles. Then, you need to assess that very early and in real time. So I can give you an example, but two companies. One, Swile. When I met Loic, it was really, what we call love at first sight as VCs, and I just knew after 5 minutes that we have to back him. And so it was at a time where they didn't have revenues; they just were launching a new product because it was a pivot. And the unfair advantage is that I had already digged into that market, so I knew there was an opportunity. And when you have already dug into a market, and the right entrepreneur comes in front of you and pitches you something that you want to hear, basically, because you feel these are the good answers, and you have an intuition about the right things to do in the space, you want to do it, basically. And Loic is, I knew after 5 minutes, and I think after 3 days we wrote a term sheet, and obviously now, the company is very big and it's a unicorn, etc. But it's also, the revenue scales. I think they published their numbers. It's like 250 million of run rate.
Insane.
Profitable. So it's a real sustainable, enduring company.
Actually, like for Swile, maybe we can build up on this because I think they did something like extremely smart where they acquire another company that was like a leader and that was making like maybe 4 or 5 times their revenue. Like at that moment, are you still on the board? Like, is that something you like watch out from afar, or were you like I don't know, in the discussions when they decided to acquire that company? Maybe you could share some stories about it.
Yeah. So at that moment, I think I was still on the board, and I invested in Swile when I was working at my previous firm. So it was called ID Invest, and so we led, the big seed or the pre-series A. So it was the first round for that product, which is the benefits products. So yeah, that was a very big move that, I think the CEO worked on for a very long time. You always have to, it never happens overnight, these things, right? You have to think about it ahead of time, and it really happens over 6, 12, 18 months sometimes. And it was, an incredible move in that market, right? Because what is interesting with Swile is that it's typically a company that was targeting an oligopoly. It's very difficult to target an oligopoly. So there were 3, 4 players, and they were locking the market. And so when you target an oligopoly, you generally require a lot of money to get to a point where you can then scale. And so Swile is typically that example that, raised a lot of money with not so much revenues at the time to get to a size that they could compete. And when they got to the size, and the growth was very, very impressive when they acquired the other player called Bimply, which was a little bit of a legacy player. They knew that this would unlock so much synergies because it's a market where the more scale you have, just the better company you can build, because you have a lot of the network effects coming with the scale.
From an investor perspective, because like if I remember correctly, like Swile was growing extremely fast, as you mentioned, in the tens of millions in revenue, and Bimply was more in the hundreds millions of revenue, but pretty flat, or like not growing like a lot. I've got 2 questions. The first one is, how do you engineer the structure of such a deal? Because acquiring a company that's bigger than you technically, or that's making more revenue than you, technically is something that no founder would think of. And the second question is, let's start with that one, and I'll jump on the other question afterwards.
Yeah, so I mean, the difference between Swile and DV was not that big.
Okay,
Uh,
okay.
but I mean, it was there was a difference, but it was not that big. Just to mention that. And then it's funny that you're saying founders are not thinking about acquiring bigger companies, but why not? Why are you not thinking about it? Maybe, the question ultimately is what's the best setup and who is the right leader to build the compounder and the consolidator if you need to acquire companies, or just a compounder, meaning you can compound over the years to hundreds of millions and at some point billions of revenues, right? And so Beauty was part of a big group, and obviously Swile was the leading independent player with a lot of innovation, a great innovation pace, a great brand. And so I think the two companies together decided that under the Swile brand and under the Swile leadership, that would also welcome the strength of Beampley leadership and the strengths of Beampley customer base, the synergies would actually be much more than 1+1, right? And
Yeah.
so how do you engineer the deal? You have to be Loic, so you have to be a founder who thinks differently, out of the box, bigger, right? And so you should never think of an acquisition because it's too big or because it's too small, but just about how together you can really build the biggest company possible at the fastest pace possible. And then, economically, you have to make it work, right? And
Yeah.
so we managed to find a way to make it work for everyone to be very happy about the deal. And BPCE, we was the owner of Beampley. They are now a very big, if not the biggest shareholder of Swile. I think it was as it's like 20% something.
So the deal was a mix of shares and cash. Is that correct?
Yeah, so I don't know exactly what I can say publicly, but
Okay.
generally it's most of the time it's a mix of shares and cash, especially
Okay.
a scale up acquires another company.
Okay. So I think what was like what's interesting for me in that case, it's like we often talk, and you mentioned it earlier, in the beginning of the episode. It's like unicorns. It was a term that's been used like a lot, and we've seen in the last year like some $1 billion company just go to zero. Swile obviously is definitely not part of them, as you mentioned, profitable in the hundreds of millions in annual recurring revenue. But still, like whenever you look at private market valuation, you see that the multiples on this market are usually like a lot higher versus public companies. And publicly traded companies are usually like best in class because they manage to, reach that IPO level. So do you think that in the structure of the deal, the fact that you can have like a super high valuation as a scale up can actually help you and be a competitive advantage in acquiring maybe like or merging with more legacy players in order to leverage basically like the value of your stock?
Yeah, I mean that it's a very good question, but it's also to acquire a legacy player or a new player. I mean, it doesn't make a difference. At the end of the day, I think the question is, is high valuation, a good thing to basically acquire companies, with stocks, right? And so, I mean, in exchange of shares. And I think this is a strategy that a lot of companies are using, and it's a great way to acquire companies. So basically, if you are the right compounder and you have the right leadership, of course, it makes sense to have, to coin a pretty high valuation to acquire entrepreneurs or companies that can, create additional value. And I mean, recently, when you see, companies like Deal, which is an amazing company raising, a very small amount, that I think it was 17 billion valuation. Obviously, this company is very profitable. So the goal is obviously to coin a valuation. Why do you do that? You do that to acquire a company, to prepare for an IPO, to potentially do secondaries for employees or tenders.
Nice. Yeah, that's no, that's cool. And if we go back maybe a little bit on the process side, because I think you mentioned, like the part that you've built among the years. So I know like you meet with hundreds of entrepreneurs every year. Maybe you could share like kind of like your system on how, like do you make sure to follow up with the right ones? And also like how exactly do you create deal flow? Because I know that I think the first time I talked with Headline, it was like 6 years and a half ago or something, with someone from your team also in San Francisco, and they kind of shared, all the tech stacks that they were building, and I think this is quite interesting. So my question is like, maybe you can walk us through, like how do you keep managing and building your relationship, and maybe like explaining if you score founder when you meet them, or if you have like a specific way of keeping the right relationship, and then like go through the full pipe from sourcing to closing with the tech that you have actually built internally.
Yeah, so I mean, Headline is now 25 years old, and so the team has built incredible tools internally, and so our approach is really to combine human plus machine. So human is, I mean, at the end of the day, the value of a venture firm is a lot about the humans. I mean, and we are trying to hire to build the best team internally. So I mean, I work with an exceptional team in Paris, two investors that are probably part of the best of the generation, and we are trying to build this great investment teams all over the world. And because a lot of our work is, as you said, it's network based, is how do you give the pattern recognition of what a great team is, but how do you also win the heart of founders so they want to work with you, right? And so you have to build the best in testing team. So I think that's the core principle, but we combined that with a lot of technology. So we had a lot of engineers internally, and we built a lot of tech, and we built two pieces. One is a sourcing tool called Deep Dive. And so basically, Deep Dive takes millions of data points, and it can be on many different fronts. It's not only about, how a company is growing its HR, which is generally a signal that triggers interest for VCs, because if you hire, it means that you're growing some, in a way or another. But we're also tracking many other things that shows growth of a company before you actually grow the HR.
Nice.
And we have our secret sauce, of doing that. And so we're very systematic. When something appears on our tool, we basically reach out, and then we start building the relationship, and then we have also a data-driven approach when it comes to analyzing the KPIs of a company, whether it's growth or very specific venture capital KPIs that very well. I mean, net dollar retention, gross dollar retention, so everything, retention, efficiency of the spend, and all other metrics basically. And we have 20 years of benchmark. So typically, let's say someone from the team looked at Lemlist 6 years ago, we can compare with a new generation Lemlist, and assess, is it growing better with the Lemlist? Is it growing better than peers of their new companies now of this generation? So we can say between the seed and Series A, between the 0 to 2 million or 3 million or 1 to 10 million of AR, this company is growing much better with better economics, with better retention. So we are very data driven in this approach, and we combine the two to make the best investment decisions.
Is it something you keep to yourself, or do you also like put it in common with other VC firms? Because if you have like like that many data combined, I think it can potentially be like super powerful also.
Yeah, so I mean, so we don't. I mean, it's proprietary.
Yeah, it's proprietary. Okay.
Only Headline using this. But at the same time, we work a lot with other VCs. I mean, a big part of our job is to collaborate and with other venture investors. It can be business angels or earlier investors in some companies we want to invest in. It could be later stage investors. And actually, it's an interesting academic and research topic. In the US, the people who did the research on venture capital, maybe not the most interesting research of all time, but still, very interesting work, show that the main source of deal flow for a VC, no matter when and what cycle you look at, is other VCs. That's what comes from, thousands and tens of thousands of interviews and basically research in the space. And so as a VC, you always collaborate with the rest of the investors to find, spot, understand which companies are doing well. And that's a way to gather data points. So let's say, you have in the Lemlist has an investor, an early stage investor, and I would try to understand, with this investor, what companies is working well, why is there, a new hire, a new contract, something that shows an inflection point in terms of, go to market, etc. So we gather a lot of information through the VC community. That's why, founders always said that they say that VCs, gossip all the time and repeat everything. And there is a truth to that.
I can tell. I can confirm. No, it's nice, and actually, it's quite funny because I remember, like back in the days, Headline was probably like the first like serious VC fund to reach out with, and it was like pretty accurate, like all the data they had. I know they were like checking traffic, backlink, like a lot of like I think they were like hundreds of things, and they kind of like shared the backend, and it was pretty impressive. So I was like, okay, this is actually pretty cool. So congrats on that. And
we actually
talking like
we use Emmys for the reach outs, which is funny, right?
Ah.
I know it's not the promotion podcast, but it's funny. So we really automate all the reach outs and all the funnel after that, which
that's cool.
yeah.
And there is something also like you mentioned earlier that I wanted to dig deep because it's maybe you can walk us through whenever you dig into a specific topic, because you mentioned it with Swile, you had done like your research for a lot of time on a specific vertical. You were like mapping all the players and the opportunity, and then there is this founder who comes to see you and he has like the same analysis that you have. So like how much time do you spend on one vertical, and maybe can you explain like how it's structured among the funds?
Yeah, so that's one of the reasons why I joined Headline initially. Why? Because we have like so much intelligence globally. So, because so many people work in so many different cities, we know what's happening in the private markets. So typically, if you say, I want to dig, or I actually realized, I realized that, the US team, they've been looking at 3-4 companies in the same space. Let's say, I'm going to give a very current hype, whatever space, but let's say AI customer support. So there's like 2 or 3 companies that are raising seed Series A's with great funds. We spoke with the founders and they have an initial traction that is, amazing. And then, you talk to someone in Asia and similar things are happening. And so then you would say, okay, there is something happening in this space. I'm going to spend more time. And, the great thing being a VC is that you can spend time with the best people in the world, specialized in a topic, and learn very fast in something. So you speak with the best founders on the topic in the US and other regions. And then in Europe, I'm like, okay, I'm going to look for something that is actually building in the space and that has a right to win in Europe, because the space is very big and a new, an innovation, something is happening in the space. It's going to lead to the creation of very big companies. And so I'm not saying we're trying to invest in copycats, but we're trying to assess what's happening on a global scale. So basically, we can have a very high degree of intelligence and information on a new trend. And maybe 5-6 years ago, it was less relevant because there was less innovation. But today, in the age of AI, so many new things are happening all over the world that when you learn about a new trend and you're very fast, you're able to invest in the category, whether it's the first one or the fast followers, which sometimes can be, more interesting. And so, that's what we're doing. And when we do sprints on something, we call it roadmaps. It can really be, over, 1, 2, 3, 6 months. Generally not in that. And then you have enough knowledge to invest in the space if you have not done that in that period of time. And we speak with all the founders, with all the players. We form convictions, what works, what doesn't work. And then you meet the 10th founder in the space, or the 5th, and you say, okay, what is saying that makes a lot of sense, because we had spoken with a lot of customers, a lot of players, and we think this is the right thing to do to win in that market.
Nice. So when you mention you speak to customers, like do you reach out to them? Maybe you look on the website and you see like, I don't know, like 5 or 6 people like giving testimonial, you reach out to them directly, or how does that work?
So first, we have a pretty big base also of MPs, and we work with a lot of corporates, and we have a lot of corporate network in every city because we're local. So I'm let's say in charge of the corporate network in France, and so I have a lot of network in there, and same thing in Germany with my partner Christian Miller, and same thing in the US, etc., etc. So first, we have access in the networks to a lot of people that can help, whether they are customers or leads or in, the ICP of this company, and so they can give a lot of details about benchmark competition, etc. And then when we can't reach out to the customers, we use platforms that help us reach out to experts. These are called the expert platform, and so we ask them to find basically the relevant people, and we speak with them like 30 minutes or an hour to understand
Nice.
more.
That's cool. And you mentioned, like I think I forgot in which article it was, but you were talking, about the AI application layer. So not just LLMs, and you were saying that Europe is also like doing really great things. I think we've seen companies like 11 Labs. I think it's like $100 million in profits. I
Also,
think like we have Lovable, which is also like growing crazy fast. Like, what's kind of like your view on LLMs versus like application layers? Because I know you've spent a lot of time like working on this, so I'm curious to understand like your vision.
in the age of AI, obviously the infrastructure plays, became very big and very interesting. OpenAI, Anthropic, Mistral, and so what is interesting is that we spent a lot of time at the infra layer, and we realized that a lot of the infra is actually becoming themselves applications, right? And so, you feel that the infra is going to be pretty concentrated over a certain number of companies. The application layer is going to be much more fragmented, a little bit like in the SaaS era, and that will lead to very, very big companies. And so, now that, let's say, the base is very solid and we kind of know who the winners are at the infrastructure layer, I'm spending more time at the application layer. So, at the infra, obviously the just to finish on that chapter, I think, the LLMs, so the text-based models were very interesting. That's why we partnered with Mistral. But the other assets are very interesting, right? And so the image and video asset to work on is very interesting. So we invested in Black Forest Labs. You also have like the other types of data, typically tabular data are very interesting. And we invested in the company that is stealth in this field, and that is, hopefully the category leader now globally. So it's Europeans, but that are building the firm, in the US as well. We invested in Bioptimus, which is more healthcare, biotech, etc. And obviously we missed Voice with 11 Labs, which is an infra company, but also an app, right? Which shows the transition and at least the full stackization of the infrastructure companies. And now, now that, these companies are, it's pretty clear which companies are winning, more or less. We are looking at earlier investments opportunities at the application layer. And so the application layer, we are interested in everything that is at the intersection of where the AI is mature and where the labor force is scarce.
So do you have an example, for example?
Yeah, so to give you the very clear example from the, let's say, the past already, are healthcare or legal. So healthcare, scribing is now AI. Legal drafting is now AI, right? We've seen it with, companies like Harvey or Ligora, and same thing with healthcare. And now we're looking a little bit at the next, the next waves of companies. Currently I'm still very excited about the text-based application, let's say the voice-based applications also in customer support. I think it's a very, very big space that is changing, and in which a lot of BPOs and outsourcing don't make sense. So I think a lot of AI is gonna eat market share, even though it's very difficult in practice for many reasons. And the second thing I'm very, very interesting when I see the recent breakthrough models from Black Forest Labs is content creation. I think this is it's an GPT moment for content creation is going to happen next year, I think. And video creation is such a big market, and it's so difficult to build when you don't have the resources. So let's say you want to do a UGC video. So let's say you need to hire an actor that is going to speak on top of your video, and you want to do it in 50 countries, and you want to do it in 50 languages. You need to find an actor in every country, and then do the process. And it's it's long, and then they will one of the actors, they will basically run your script and they will make mistakes. I think this is typically where it would give access. AI will give access to things they couldn't do to a lot of SMEs and companies. So I'm trying not to be too theoretical. So that's, a precise example.
And do you feel like the biggest opportunities in AI? Because right now, like in the example you gave, you have two ways to look at it. One way is to say like we're replacing actors and this whole process of hiring people in 50 countries, etc. Like it's basically like not gonna happen anymore. So it's basically like replacing jobs, and it's a huge market opportunity. Or do you see it more as you mentioned, like some companies just don't have the budgets. I mean, they couldn't do, like such campaigns before, and therefore it opens like a much broader market to, let's say, 10 times or 100 times the size of what it was before.
Yeah, to me, this is the most interesting opportunity. And this is what I believe in, is that, AI is actually an enabler for a lot of companies or people to do things they couldn't do before, just because it was too costly or too long, or, because they couldn't afford, basically. And I think it's true on a lot of different things. Maybe not as well yet as a human in some cases, etc. But, this is opening, opportunities at times you couldn't do before. I think this is the exciting opportunity for me and for SMEs and people who can afford, is that AI is opening new possibilities to scale and to become more professional and more approachable for a lot of people.
Nice. I want to be cautious of the time, so I want to dig deep also in the secondaries, the cash incentives. I'm curious because we've seen rounds, with hundreds of millions raised at very like early stage, things that we never like had seen before. Have you seen like secondaries happening very early in some of the AI companies? You don't have to mention any names, but and if that's the case, how do you like balance, like the percentage of the total fund versus like cash outs for either employees or founders?
So talking about cash a little bit, I know you like it. So I'm secondary. So I mean, I don't see so many companies at the earliest stage. And it depends on what stage you talk about. But at the seed and Series A in Europe, generally you have no secondaries. I mean, also these, in the age of AI, you have a lot of seed companies raising very fast Series A, and the company is sometimes pre-revenue or is not, let's say, sustainable yet. So, you don't see a lot of secondaries. The way, at least I see things, and most of the VC community sees things, and gratefully, most of the founders, is that the most important is primary capital. So that's the first priority, is to capitalize the company. And the company is what you have to optimize for, is all the shareholders, including the founders, which, who are the biggest shareholders, especially at the earlier stage, right? And so it's always about primary capital. When you have, too much, more demand than what you need in terms of primary capital, then you start talking about secondaries. And these discussions, are healthy when they start at the Series B, I would say, or at the stage where the company, becomes sustainable.
Okay. And whenever that happens, let's say at Series B, like what's usually the percentage of the amount raised that can go to secondary, and what's kind of the split between founders versus like employees?
It's a very good question, and secondaries are, they are very important, and they're also very healthy, both for founders and employees. And it's actually, you can really turn it into a superpower, right? And for everyone to see the real value of the companies, that you can actually get cash at some point out of it. It's always we love having this discussions very transparently with founders. It shouldn't be a taboo, right? And so it really depends on the type of company and the founder to decide what is healthy in terms of amounts. It's healthy to take secondaries because at some point, you as a founder, 100% of your wealth is your company, right? And so what you want to optimize also, as a VC and, also as a founder, is to is not it's not financial anxiety, which is the case when you do zero secondary for years and you don't get any money out of the company. You want to optimize for de-risking, to take enough risks, right, to get to a very big size. And as me, that if you want to get to a very big size, you need to take more risks. You need to maybe try to acquire a company like you did with Clap, which is a very good book. Congrats. But and to do that, you also you to use that money to do additional investments and to take additional risks to bring the company forward and to a bigger size. You need to do that. So secondaries is always a very healthy and a very good idea at the right stage. And so, especially if you want to, pay back a loan, if you want to do a down payment for a home, if you want to you have a big family, you need to pay for schools or whatever. I mean, and so the now to get very concretely, in the amount, I think it's let's say what I see and what I think is, relatively healthy is maybe, one single digit of what the founder has. So, let's say 7% of what the founder has, depending on what it means in terms of amount, but can be a good thing to liquidate and to get liquidity, after Series B or C or at some stage, right? And so, and generally in terms of amounts, let's say it's, between $1 million and a few millions, maybe up to 5, or I'm talking European standards. It's more in the US just because cost of living is also, much, much higher. Sometimes it can be a little bit more than that. And then you have employee liquidity, right? And it's also super important. And it's an important moment, right? It can't be something you do continuously and it's a secondary market of everybody sells and buys. I mean, it has to be earned and to be a reward for the people who are performing, who have some tenure in the company. So generally we say, liquidity is available for people who've been in the company for, let's say, more than 2 years and who are the best performers. And then you incentivize the right people to, get some liquidity, which shouldn't be a lifetime event, right? At the Series B, it should be something that, same thing, is relieving financially. And then you need to reset and reboot for new expectations from these people to bring the company to the next stage, right? And so in terms of, let's say percentage of the fundraise, it can also be, 5%.
Okay.
Like overall 10% for employee plus founder liquidity. Can make sense. Yeah.
Nice. And as a fund, because you start, investing, very early, like pre-seed, sometimes seed. As a company scale, when do you decide, like, as a fund, I also want, to generate, obviously, like, money for my LPs. So when do you decide, like, to sell your shares in the company? Do you do it, like, fully? Do you do it, like, step by step? Like, how exactly does that work?
It's a good question. There are two answers to that. Obviously, our job ultimately is, to give back as much money as we can to our LPs. And so that's really our goal. And so, you need to generate liquidity. What's very particular with the VC industry is that it's an outlier job. So basically 1, 2, 3, 4 companies, they will pay massively. If you look at a business model of a VC firm, that's what happens, right? And so you really have to get into these companies. So the not the unicorns, but the decacorns, the compounding companies, and very, very big companies at scale. And you need to have a decent percentage of these companies. And so it's always about, not selling too early, but also not missing the window to sell, right? And so it really depends on where you are with the fund and when you need to generate liquidity. If you've invested a fund for 10 years and you don't have enough liquidity, it makes sense to start liquidating and do some secondaries in some companies to start giving back money to your LPs. It's very important to show that, you can generate actually liquidity. If you have a fund that is, 10 years in and you already gave back 3 or 4 times the fund to your LPs, and you have, which is the case for some of the headline funds, and you have like, 1, 2, 3 big assets, you have no rush, because then you can optimize for very, very big multiple for the last piece, right? You don't keep it for 20 years, but let's say it makes sense to wait for an IPO or a very big sale and not sell too early as well.
And do the founders and other funds have like similar rights? Like how exactly does that work? Like, for example, if you decide to sell some shares? Do you have to tell the board about it? Is it like something you can do like a bit below the radar? Like how exactly does that work?
It really depends on just shareholder agreement. For us, I mean, we are in a business where, reputation is probably the most important things. And for us, also, obviously, we work for IPs, but we also work for founders. And that's probably our North Star on a day-to-day basis, like on an operational basis. And we always lead or co-lead. So we are very close to the founders we work with, and we work together with them almost as co-founders to build very big companies. So we never do these things in the back of the founders, and we always work together, on what's the best moment to do it. Also, not to send the signal we don't want to send if we sell, because some people can interpret things in the wrong way. So secondaries, as I said a little bit earlier, it's never continuous. It's always moments, and if for founders, for employees, and for VCs, and what is the right moment and the right stage in the company for us to sell. In some companies, we sold many years after the IPO, because it was the fund has already given back, and most of a lot of DPI, and so you can wait. In some cases, you also sell a little bit earlier, not all your position, but maybe a little bit, and then a little bit more to show the company is actually liquid, right? And we never do that in the back of the founders. It's always in discussion.
Okay. And when it comes to like terms, I know like as a VC, you often invest with like a liquid pref, but how exactly does that work? When you have like obviously like seed, then you have other investors coming in Series A, Series B, Series C. Like how exactly do you negotiate the terms when you enter early? Because the reason I'm asking is typically I've done maybe like around like 30 investment in startups, a lot through like safe, or like where you basically have like common shares or whatever, and that even though you get like a small chunk of the business early, down the line you can really get pretty much nothing if some VCs enters with like 1, 2x, 3x liquid pref, etc., etc. So in your case, like how exactly does that work, and do you have like a kind of voting rights where you can agree or disagree on the next funding round terms?
Yeah, so I mean, the way it works, and we are in the business of building cap tables and terms that scale. So to come back to the beginning of the discussion, we want to back compounders and companies that scale. And if you want a company that scale, everything needs to scale, and in particular the liquidation preference and the cap table, right? It's very important, the governance, right? And so we work on plain and super standard terms. And so the term is that in every round, you have a new share class, which is called a 1x non-participating, which I can invite everyone to ChatGPT if they want to understand what it means. But basically, it means that it's not complex. It means that in every round, it scales just because the new investor, he has a preference if the company sells. So typically, if in the seed round you raise, let's say 3 million, and then so you have like seed shares that are preferred, they're on top of the ordinary shares. Series A, you raise 15 million, it's on top of the seed shares. And so let's say, you sell the company at the very minimal amount, then the preferred shares have the right to take the money before the ordinary shares.
So basically, the latest investor will always get its money back first.
Yeah, so it's a little bit more complex than that, because we generally, you as an investor, you never sell the company.
Yeah.
So the truth is that you also have to incentivize the founder of the company, right? And so what we generally do to do that is you always have a carve out, which can be between 5-10%. It really depends on the cycle. And basically, if you sell the company for less, the founders, they take the first 5 or 10%, and then it flows into preference.
Okay.
That's the
little loophole. But technically, it can also mean that if you were there like in Series A or seed, and then eventually like in Series D or E or whatever, like maybe a series that's like much later, for some reason they raise a lot more, but they can't like reach the ARR goals or whatever, it means that technically as an early stage investor, you could get nothing.
Absolutely. That's
Okay.
the concept. Yeah, the
Okay.
concept.
Okay.
That's
Okay.
the dump part of the stack. And then, but, as I said, we also work always at the board of the companies and generally very close to the founders. And we try to avoid these situations where a company would raise it too high of a valuation, too much money when they're not at the right stage. Because, I actually, I'm going to say something maybe a little bit contrarian, but I think it's very important for founders to have optionality. And so you always have to raise it a valuation that allows you to have optionality. Optionality is optionality to become profitable, optionality to sell the company if you have a great offer, optionality to raise more money. And so at every stage, you have to assess that and assess, as a founder, more than a VC, early stage VC, as a founder, do I have the optionality? And if you raise 200 million at a billion, when you do 5 billion at revenues, you don't have a lot of optionality after that. You have to
Mm.
execute perfectly, and the market has to be what it is, which is very hyped, very hot, and the capital has to be available. And so we try to avoid this situation. We don't care about having a big multiple on paper. Money on paper is not money, and valuation on paper is not a valuation. And that's why we have a lot of zombie unicorns from 2021. What we care is about building the right cap table at every stage to maximize the path to build a very big company. And that's not by doing follow-on rounds very quickly with no milestone reached at crazy valuations.
Okay. And I feel like with the AI, we started to enter like kind of a new era, because the valuation we're talking about, and I've invested in companies like Grok on secondary market or these kind of things. And you see the valuation is basically quadrupling every 6 months or whatever. Like it's pretty insane. And we're talking about insane numbers. I think OpenAI recently was like 500 billion or something like this. So it's things that we've never seen before going like that fast. So how exactly, as a VC, do you like decide what's an honest valuation and that you're not, way out of market?
That's the $1 billion question. So, especially, but that's exactly the job. The job is to try to figure out in which company you can actually invest at such a valuation and in which company you cannot. And so, the way you think about it, you have like two aspects. One, which is the one I'm always thinking about, is, long term. There's long term, this company can really build a very big company that can generate a build multiple from there. And obviously, to think of a company like Mistral and just AI, generally speaking, especially at the infrastructure layer and very horizontal play, the market is so huge that you can deliver, like OpenAI is 500 billion, but it's going to be 1, 2, 3 trillion. It's going to be trillions. And, so you can invest at such valuations, even though, it looks, high. If you look at the revenues today, it's actually not that crazy. I mean, OpenAI is already generating tens of billions of AR, right? So, it's and at the same time, a non-AI software company that is growing very fast, but in a smaller market, or let's say a vertical AI company that is in a market that is a little bit more capped, you can't invest at, crazy valuations, because then it's very difficult to underwrite what you want to underwrite, which is 3 or 4 or 5x a 10 billion valuation. I'm thinking about very late stage rounds. So
Yes.
that's the first study is like, ultimately, does the market size that I think is reachable allow very big outcomes, and at this kind of stage still like 2, 3, 4, 5x?
Nice. I want to ask maybe like one last question. What's one company that you could have invested in and that you decided not to, and today that is like really, really like striving?
Honestly, I mean, there's so many companies that we list in the past years, and so I think 11 Labs is a very good example where it's a
Okay.
company we dream to invest in, and they're executing super well. So for me personally, I think Penny Lane, which is
Mm,
it's not an AI etc. crazy
yeah.
company, but it's
I had
funny because
Arthur on the podcast actually.
yeah, bro. Yeah,
Yeah.
Arthur is great, and the founding team is also great. And I think it's typically it's not an AI crazy LLM, but if you think about compounders, like long-term compounders that can, generate hundreds of millions of ARR, even maybe more, at some point, if they crack international and some expansion topics. I mean, it's typically the right company to do so, right? And it's enduring and it has moat, right? And so when they raise let's say the Series A, which was actually a very big seed, they were pivoting. And so, I knew the team was amazing. And but the way they were approaching the market was not the right angle, and I knew this was not the right angle and it was not scalable. And they also kind of knew it, and they decided to pivot after the round. And so, the lesson is always that, the best teams, they build the biggest companies, and they know how to iterate and navigate, to come back to what we were discussing. And if at the end of the day the market is big enough, they will find the right business model, which is exactly what Penny Lane did. So, congrats to them.
Awesome. Thanks a lot, John.
Was a pleasure. Thanks a lot for inviting me and spending that moment together.